The next item that the auditor needs to look at is whether the company has incurred cash losses in the particular financial year or in the preceding financial year. The term cash losses, unfortunately, does not feature in any of our accounting standards. Neither does it feature under the Companies Act. So what the ICAI guidance note has done is they have provided inputs around how does one go about calculating cash losses. Remember, you have cash flow from operations in the cash flow statement, but that is not quite cash losses. That is not an indicator of cash losses, because you could have companies where there is substantial and relevant interest income or interest expense. Now, if you only took cash flow from operations for those entities and excluded interest income, interest expenses, one would really not get a true picture. and therefore, the ICAI guidance note gives some guidance around how to deal with this assessment. It says, take the net profit or loss after tax as a starting point. Because this is not readily available, please use some form of an indirect item or an indirect approach to get to the conclusion. So start with the net profit or loss after tax, add back non-cash items. Now, it's very easy to understand some of these non-cash items. Certain non-cash items can be quite tricky. So non-cash items like depreciation, amortization, impairment, they are all to be adjusted or added back. Non-cash items like deferred taxes are also to be added back. Now, where the confusion arises is on two items. The first set of items are items that are unrealized in their nature but not non-cash. So for example, if there is a fair value change, while it is not a realized fair value change, one cannot automatically say it is non-cash, right? Because at the end of the day, when one sells this or when this is realized, it is realized in cash. At that time, it will impact cash losses or cash profits. So to clarify or to put a rest to all of those kind of issues, the guidance note once again brings out a statement to say that foreign exchange gains or losses, fair value changes, whether they are gains, losses, they all need to be adjusted to the net profit after tax. For companies that follow Ind AS, the second item which could cause confusion is OCI, because there could be items that are first parked in OCI and then are reconciled to the P&L. So to give you an example, if there is an item of a cash flow hedge reserve, it is sitting a part of in OCI in the current year, but in the subsequent year when the underlying item hits P&L, that amount gets reclassified from OCI to P&L. And if my starting point is net profit or loss after tax, the reclassification is sitting in this amount, whereas actually the transaction had been triggered in the earlier years. So again, a tricky item in terms of how one deals with this. Two possible conceptual approaches possible. One conceptual approach is to say, I will start with net profit after tax, after OCI, or I will include my comprehensive income for the period and then do this assessment. Or I will start with net profit after tax and then manually specifically adjust items that are realized or recognized but are sitting in OCI. Once again, not a very clear-cut assessment, not a straightforward assessment, but this is where the guidance note has left it at. So what will be our key takeaways from this is that cash losses or cash profits are not cash flow from operations. They are not distributable surplus. Interestingly, if there is a qualification in the audit report, if that qualification is quantifiable, then the cash profit needs to be arrived at after giving impact to the qualification. Something similar to what you would see in preparation of restated financial statements for an IPO. And finally, the reporting is for current year as well as preceding year. So if there is no cash loss in the current year, but there was a cash loss in the preceding year, then the auditor would need to separately report this, saying there is no cash loss in the current year, but there was a cash loss in the previous year. That brings us to a close around what is required to be reported from a fundraising standpoint. If one had to look at the other clauses in CARO around raising of equity shares, raising of preference capital, preferential allotment of shares, and those kind of clauses, absolutely no change between CARO 2020 and CARO 2016.